Hello, everyone. Carl Weiss at Fairway Independent Mortgage Corporation. For the next segment, we are joined today by Mr. Seth Fink, certified public accountant, who is helping us break down some concepts of federal taxation. And we're going to kind of jump into the second segment. In the first one, in case you haven't seen it or need a refresher, it's really kind of the basics, and we're getting rid of a lot of the jargon and nomenclature that's thrown around. And we're just using these as building blocks so that everybody really has a solid foundation of understanding, as well as, terms that make sense, so that we understand how a lot of the taxes get to the point where we get to a federal tax return or a state tax return. In the previous episode, we discussed the types of income, that being W-2 and 1099 predominantly. And so I'd like to jump back in, Seth, with that and say, okay, we have a good foundation of some of the things that we talked about before. In the world of taxes, we're kind of surrounded by these things, right? So we pay a lot of taxes. And so, if I take a look at a borrower's pay stub, for instance, we're inundated with OASDI, Medicare, FICA, federal withholding, state withholding. Then we have property taxes, sales tax, ad valorem tax, value-added tax, estate taxes, taxes on gains, taxes on interest, taxes on dividends. So I'd like you to, from the earned income perspective of like a paycheck on a W-2 wage earner, can you kind of help us understand what taxes are literally being pulled out of our earnings before we receive them on the withholding, and what they're for and what do they mean?
Gotcha. So let's start with Social Security and Medicare. So your wages are subject to withholding 6.2% Social Security, 1.45% in Medicare. So the Medicare portion, of course, goes to paying for the Medicare system that you're paying in now, that you're going to be eligible for those benefits at age 65 to get Medicare health coverage. The 6.4% Social Security, that refers to the amount going into your government account for your future Social Security benefits. So you can't call it a pension because it's not. But that amount is what's going in, and it really is a tax. It's a tax based on your earned income. And then based on that earned income, at some point in the future, you're getting this government promise to give you some annuitized income when you start drawing those Social Security benefits. On top of that, you typically have your federal income tax withheld and your state taxes withheld. And those are all based on your taxable wages. Some states, Arizona is not one of them, some states have a local tax. So cities have their own separate tax versus a county or state. Wow. That's more common on the East Coast. So okay. New York and New Jersey has that, Ohio has that, Pennsylvania has that. So a lot of these jurisdictions, you'll add an additional tax for a city tax. So those are all the things that typically come out as taxes from your paycheck.
And when we get down to, filing tax returns, and we actually get into the nitty-gritty of, figuring out our all of our income and all the expenses and deductions that we may be eligible for, or credits, and then we end up with either, owing money or zero, which probably never happens, or a refund. Are any of those, besides the federal or state withholding, ever eligible for refund? I assume that the OASDI, the Medicare, the FICA, those are not.
They are not, because they're just based on earned income. But not to be too confusing, there's a caveat to that, which is if you switch jobs during the tax year and your total wages exceed the Social Security cap for any given year, last year was $168,000. So if your total wages are $200,000, but you had two jobs for $100,000 each, you will, on your tax return, get refunded for the overpayment of the employee's part of Social Security, not Medicare. Medicare is based on all income, but on Social Security. That would be the only instance you would ever get that refunded to you.
Interesting.
Yeah. Okay. Other than that, that would never be. It's just going to be the over or under on your federal or state withholding.
Okay. And is it, can you talk about the, that's from the employee's perspective, right? Those are things being withheld from the employee's paycheck.
Right.
What is the employer paying for the employee? They are responsible for some taxes too, are they not?
Right, they sure are. So the employer matches your Social Security and Medicare withholding. So you are, between both of those, having 7.65% withheld from your check on your total wages. Your employer pays the exact same thing. So in the employer's world, that's called payroll taxes. Their share is payroll taxes. So the sum of the two together is 15.3%, half for the employee, half by the employer. The employer is also paying for unemployment taxes as part of that. So for federal and state, they're contributing to an unemployment fund. So when somebody does claim unemployment, there's a pool of funds that they get drawn from. That's where it comes from, funded by companies as they pay unemployment for all their staff.
Yeah, I don't think employees understand that the employer is paying, 50% of that. And that's really kind of that's an amazing benefit, because if they were self-employed, my guess is that they would really be responsible for all of that.
That's 100% true. So if somebody is self-employed, they have that 1099 NEC and they do a Schedule C, they're paying the employee and the employer portion.
Mhm.
They are paying both.
Interesting.
That's correct.
So be thankful to your employers, people. Um, it's interesting. You kind of brought it up during the last segment, and we've touched on it a little bit. Like, you know, federally, obviously, we understand about, federal taxes. The states seem to be different, right? So, Arizona now is, I understand, is part of, it's more of the state tax is a flat tax for Arizona,
Mhm.
earned income. Where do those funds go, and why are there some states that don't collect, uh, state tax?
Right. So in the state of Arizona, they voted in this 2024 as the first year, this 2.5% flat tax. So it goes in the state budget for covering, paying for roads and schools and government and all the other sorts of things. And that's in addition to all the other taxes a state collects, which could be real estate taxes, sales tax, those sorts of things. Some states that don't have a state income tax have other taxes to make up for it. They might have higher property taxes. They might have higher sales tax. So they're getting their state income from some way or another. So if they're not getting it from state income tax, they're getting it in other parts, which is why, retirees often look at states that don't have state income tax or very low state income tax for their retirement. But then you have to look at states. I'll give you an example, Texas. Texas real estate taxes are very expensive compared to Arizona, but there's no state income tax. Not a great place to be a fixed income retiree when you pay 4 times the amount you would in Arizona for real estate taxes. Now, just as a side note, in the state of Arizona, there's 2 types of income that are tax-free. Social Security benefits are tax-free. Actually, 3. Okay, so when a retiree collects Social Security, you won't pay tax on that in Arizona. Active duty military do not pay state taxes on their wages. And anybody who has retired from the armed forces with a military pension does not pay state income taxes on that pension. So Arizona is very favorable for seniors and very favorable for military as a place to live for those reasons.
And that's a state by state kind of basis, I assume that's not universal in all states.
Correct. Every state is different on all of
Okay.
those matters. So it's always important to know what's good in your state. I'm talking with someone from Florida that's looking to move to Arizona. They're on a fixed income, they're retired. Their income is primarily Social Security. I'm like, you'll be fine. You won't have any state tax.
Right.
Right. So it's really no big deal for them. But it's one of those things of understanding the state you live in or the state you could move to, what those rules are and how it would impact you.
Well, and maybe as a good dovetail is something I wanted to bring up later, but I think it might be applicable now, is when we talk about Social Security earnings, in the air, if Arizona, for instance, is a state that has no income tax on Social Security benefits being earned, on the federal side, as I understand it, I hear this conversation from seniors all the time that my additional part-time job is throwing me over the limit and I'm now being taxed on my Social Security.
Mhm.
Can you help walk us through what the actual rules are for the federal Social Security taxation?
Oh, that's great. So, in and of itself, Social Security is taxed based on all your other income, earned or unearned. Okay. So, if somebody is living on Social Security and has nothing else, they will pay no federal income tax. You can have up to around $13,000 of other income, whether it could be a part-time job, a little bit of interest in dividends, whatever it is. As long as that number is under $13,000, you'll pay no taxes on your Social Security.
Even the $13,000 scratcher that
Right.
we issued a 1099 for,
Exactly.
would that
Exactly.
count too?
Right. Exactly. Any income. So when your income goes above that $13,000 floor, then your Social Security starts to become taxable. And the more you earn or the more other income you have, the more a higher percentage of your Social Security becomes taxable. It maxes out at 85%. And I don't mean 85% tax bracket. It means the most of your Social Security that will be taxable income is 85% of the benefit received. And that's usually when you hit about 30, I think it's around right on 33,000 of income, your Social Security becomes fully taxed at 85% of your benefit.
Okay. So 15% essentially is just never taxed.
Correct. And that equates to how much you and your employer put in. Kind of,
Interesting.
it's not terribly it's not terribly different. I mean, it's not exactly the same, but that's kind of what it equates to because you already pay taxes on that money when it came out of your check. Your employer got a deduction, but you got that benefit. So that's kind of where it comes from.
And since we discussed last time as far as, our system and how the marginal tax bracket works, I mean, just looking at a tax table, briefly, let's just say that, you were in that, you're a senior earning, $1,000 a month in Social Security. So there's 12 grand and you made another 15 grand. Okay, so we're sitting around $30,000. Would you ever advise that person not to take the additional job to have their Social Security taxed?
I mean, in a case where they just went over the $13,000 cap, it's just a very small amount, so it wouldn't make a big deal. But you could be looking at, let's say their part-time job is earning them $25,000 a year. Now,
Mhm.
that's a big deal. That means they're only not only have taxable income on those wages, but now they have taxable income on the Social Security. The answer is it depends, and I hate to give that, but it
Sure.
depends on the genetic makeup of somebody's tax return. And you can do the math with their standard deduction or if they're itemizing and figure out how much can they earn and really not be harmed by going over the limit to start having their Social Security taxed.
Yeah, I love that because I think so oftentimes we hear more of the absolutes, right? Clients are like, I can't, I just, they won't let me, or I'll get, murdered tax wise. And you go, will you? I mean, you're going to be in the 12% bracket.
Yeah.
How killed are you really going to be? And what would that money from that additional, earned income mean for your lifestyle, right? That's the other component, right? Is
Mhm.
you could look at the taxes on one side of the coin, but there's also actual earnings on the
Right.
other that go into your bank account, and that might be a worthwhile venture. So yeah, I like that we really just need, without having the absolute, we just need to examine it and see what really makes sense, right?
Because
Some will, some won't.
it's a little bit different for everybody. So you got to look at their situation and determine what is most appropriate based on their facts and figures.
I love it. And as you mentioned, and we've talked about this term, and so I want to kind of just back up and hit on it because I hear it used incorrectly often.
Mhm.
When we talk about tax deductions,
Mhm.
can you just kind of walk us through what exactly is a deduction? What do we normally mean when we use the word, and how does it actually come about? What got us to that?
Got it.
Because I
So,
think people miss the other half of that equation often.
right. So a tax deduction are items that reduce your taxable income. So for an individual, your deductions are things like medical expenses over the threshold. They might be state income taxes paid, real estate taxes, car registration. The majority of the car registration in Arizona is property taxes. That's deductible. Mortgage interest, charitable contributions. Those things together create a deduction that reduces the taxable income on your tax return.
Okay, and how do we get them? Like
Um,
what had to happen before we got the deduction?
um, you had to actually spend it.
Had to
So,
spend the
I
money.
mean, you got to spend the money. So, I always say, when people are looking at trying to save tax dollars, you have to spend it, you have to donate it, or you have to defer it. So, spending it is on tax deductible ways for an individual to be like qualified medical expenses, mortgage interest, real estate taxes, that sort of thing. Um, Donating it would be your charitable contributions, both cash and non-cash. Your deferral are things like 401ks or IRAs where you can put money away and take a tax deduction for the amount that you contributed to those accounts. So those are the three ways you create deductions as a standard 1040 W-2 earning taxpayer.
Okay, and yeah, and that's the part, the I had to spend the money to get the tax deduction,
Right.
I think is the part that people miss. It's not an ethereal coupon that's
Mhm.
out there that they just pluck out of thin air and throw on their return. It's normally created because there was an expense,
Right.
and a liability that came about that created the opportunity to use a deduction to, lower the tax bill
Right.
or burden.
Mhm.
Um, So again, as we talk about kind of everyday, hey, we got a job, we got a couple, there's one, there's two employers, we're W-2 earners. What kinds of receipts and paperwork should we be keeping track of throughout the year? Like, and how? Like, what's the best way? What have you found that really works well for people, and what should they really keep?
Um, Anything that you're going to utilize for your tax return, you should keep those receipts. So medical receipts for getting your prescriptions or co-pays, all that should be maintained. Um, Anytime like you pay your car registration, the registration form has that personal property tax on there. Your charitable contributions, keeping track of all those checks you wrote or credit card receipts. Some charities will give you a letter, some will not. It will just depend on the circumstances. So any of those sorts of things you would maintain. In addition, we tell people to keep expenses and receipts related to their home, because if you end up in a situation where you may have a taxable sale on your home or it's an investment property, having that information can help reduce your taxation as well. So those are the types of things we want you to keep. Tell Standard record keeping requirement is 7 years. At least you have to keep those records for as long a time as your tax return is eligible for audit with the IRS or with the state, which is 3 years for federal, 4 years for Arizona, from the time the return is filed or the due date, whichever is later.
Okay, so encapsulate that one more time for me. So is 7 years a better,
It is. I mean, it's just a good rule of thumb.
a good
Because
rule
you
of thumb?
went,
Okay,
like, because if you went back and let's say 2 years later, oh my gosh, I found a mistake on my tax return, and you go and amend that tax return, you reopen the statute for another 3 years. So
gotcha. Okay.
you want to keep those documents for 7 years as a rule of thumb.
And how far back can you go to amend those? Is that why the 7 years? Is there a limit on the?
Yeah, so typically it's 3 years back to get a claim a refund. So the IRS will let you go back 3 tax years to
Okay.
claim a refund on something. So that's kind of where that 3 plus, you get close to the 7 years
Yeah.
that.
Okay. Good.
Yeah.
Good to know. And how would you say is best for people to? I mean, we live in an electronic world. There's apps for everything.
Mhm.
We have paper. We have files. Like, what have you found that really works well for people to keep stuff, and how?
Our more senior clients will do everything with paper. So they'll have a folder, they keep all their tax receipts in, and some of them may bring it to us during tax time. They'll maintain that with their tax returns when they're all done and kind of keep it all filed together. Our younger folks will tend to do everything digital. So
Okay.
the IRS will most definitely accept PDFs of digital files. So if you have your medical receipts or this or that, you can scan them all in, keep a folder on your computer with that year's tax documents all scanned in. The side note is please do a backup. Don't if you put it on your computer, make
Yep.
sure you have a thumb drive or a portable drive where you're backing that data up too, because when your computer crashes, you have no backup. Now you have no verification. So I
Okay.
always have a duplicate system, especially if you're going to do it digitally. But yeah, so that works just as well to be able to provide that information. So like for our clients, they send us all their documents or they scan all their documents in and we maintain a file of all that. So if you came to me and said, man, I need my tax docs from 3 years ago, I can send you a file that has everything in it that you gave to us.
Fantastic. I love that.
No,
And just a great way to know, just to, sort of declutter, right? But
exactly.
if you're keeping the paper, I think, it's always important to remind people just, if you're going to get rid of those old, 9-year-old, 8-year-old, forms, taxes, returns, please shred those. Um,
Right.
you
But
know,
one other caveat, and you're going to like this one. This one of the things I tell people is save. There might be a 7 year document requirement. That is the recommended amount of time for maintaining taxation documents. I tell people to keep forever loan settlement statements, purchasing, refinancing, selling properties, any lien releases, and vehicle notes. When you get the lien release, when you pay off your car, save that. And those documents should be saved in a permanent file someplace forever.
yep,
I
it's a great
say this
idea.
because we've had it happen. I've seen it twice now, where somebody paid off a lien on a property, passed away, kids are taking over the property, and the lien shows up someplace
Whew.
and it never got properly recorded and released by the title company. And it took months of digging to find the information to go and supply it to prove that the lien was actually satisfied. And it was only because the taxpayer had all the parents' records, she could go back through and do all that. So thank God mom was a hoarder, had all that information. So I tell people, keep that stuff in perpetuity. I have everything that you've ever done for me in a folder in my closet with every buy, refi, or sale settlement is saved. I scan them in digitally too, but I have all the paper copies of all of that.
Yeah, great recommendation. I love it.
Yeah.
Yeah, and yeah, all the reconveyances, all the deeds, everything
Mhm.
that would really cause you massive pain. That's kind of where I put it on my personal spectrum. Everybody could be different. So not really a recommendation for everybody, but for me, if it would cause pain for you or your family if you died that you couldn't put your hands on something, you
Mhm.
should keep that forever,
Right.
right?
Exactly.
Um, Other tips and tricks as we kind of talk about what we need to keep. I know one of the things as it relates to, and I'd like to jump into sort of the standard deduction versus itemizing, right? Because that's such a big overarching, I think, category for people because I feel like and you can kind of describe it, but everybody sort of gets something, and,
Mhm.
and some people may get more.
Right.
Is that a fair way
Oh,
to
totally.
sort of
That's
describe the
exactly it.
deduction side of the world?
Yeah, exactly. So, the standard deduction is the amount the government gives you out of your earnings that you don't pay taxes on. Again, there's a separate amount for single tax filers, people filing head of household, people filing married, filing joint. Okay, the married filing joint get the highest standard deduction, head of household gets smaller one, single gets the smallest one. Now, if you get to take the higher as a deduction from taxable income, you get to take the higher of the standard deduction or the itemized deductions. So the itemized deductions in general include for federal tax, medical expenses over 7.5% of your income. It's called a floor deduction. So anything over that 7.5% floor, all state taxes paid up to a cap of $10,000. You might hear people talk about the SALT limit, state and local tax. So up to $10,000 of all state taxes are deductible on your Schedule A as an itemized deduction. Mortgage interest, charitable contributions. Those are your primary areas. So if the sum of all of that stuff exceeds the standard deduction, then you get that higher amount to itemize deductions against your income. If your itemized deductions are below the standard, you get the standard.
Okay, so let me just recap that back because I think the number that we had before for the single filer was 14,600, I believe,
That's for
uh,
2024, correct?
for 2024. So that's the standard. So, again, whether you have that much or not, you start off and you're given that amount of money to deduct from your earned income to
Mhm.
reduce the amount of taxation that you're going to pay based on the tax tables on your income. Uh,
Right,
for easier way to say it.
right.
However, if and they you don't have to necessarily be a homeowner uh, to go from a standard deduction to an itemized, but I feel like it's a fast pass in a lot
Yeah,
of cases.
right.
And you can jump on that too if I'm
Yeah.
misunderstanding that. But
No, you're right on the in 2018 with the Tax Cut and Jobs Act, that legislation doubled the standard deductions. And when it did that, it made it
Mhm.
much more difficult for taxpayers to itemize. Now, some people, especially people that don't own a home, really got a big boost in their tax-free corridor, how much of their income they're not paying taxes on.
Correct.
It is entirely possible to itemize without owning a home, but it means you have a lot more charitable or um, a lot more health, related medical expenses, right?
Okay. Right.
So it's possible, it's just less common. People that are homeowners, if they have an older mortgage at 2.5%, don't you love those days? There, many of them still can't itemize, but people that are buying homes in the last year or so at 6, 7+%, they're itemizing. And they're able to, because that mortgage interest and their real estate taxes and their medical and their charitable is throwing them over that standard deduction much easier than when we had nice cheap interest rates.
Right. And that's why, in the financial world, we're given that mantra of I can't give you tax advice, but
Mhm.
owning a home may be beneficial to you. Please consult your tax advisor for your specific stuff on that. So in that vein, we hear things. So okay, so it sounds like we've encapsulated medical expenses above the floor, that 7.5% basically of in the old days we used to call it adjusted gross income. I don't know if it's still
Still
called
is, yeah.
that.
Mhm.
Um, uh, that will help you on the itemization train,
Mhm.
as well as the state and local taxes. That includes for a primary residence, that includes property taxes, I assume.
Property taxes, it includes your state income taxes withheld from your check or paid to the state during the year. It includes the personal property tax portion of your car registration. And if you're fortunate enough to have a second home, it would also include the real estate taxes
Oh,
for that second home, again, up to that 10% cap or $10,000 SALT limit.
okay. Plus mortgage interest, obviously. Would that also include the second home? So the
Yes.
primary is a given,
Mhm.
but we'd add in the second home if you had a vacation property. Any
Right.
limits on that? Because you're allowed to have as many vacation properties as you like from the lending point of view.
Right. It's typically mortgage debt over $750,000. The interest isn't deductible any longer. It used to be 1 million, and that got reduced a few years ago. So it's 750,000. And if you have a mortgage for $1 million, and the 750 is the cap, then the interest on the $250,000 portion would be non-deductible. So there's a mathematical calculation to it. So there is a limit to that.
So if you had three vacation properties at $200,000 a piece, let's say, may
Mhm.
not be a problem adding those all up as long as you didn't exceed the 750. And
Correct.
that category is separate from the primary residence.
No, it's total,
It's total. Okay.
all mortgage
Oh,
interest. Yep.
awesome.
Primary and secondary. Yes, sir.
Fantastic. And then the last category was basically the charitable contributions, I believe.
Correct. So that would include both cash and non-cash contributions. So cash contributions, you wrote a check to your church, to the Red Cross, to your favorite place, the ASP, CPA, SPCA, whatever it might happen to be, as long as it's a bona fide 501(c)(3) charitable organization. Does not include like political organizations; those don't count. But if it's a 501(c)(3), it absolutely counts. And same thing for your non-cash contributions. When you go to Goodwill and you drop off a pickup truck full of stuff to their Salvation Army or St. Vincent de Paul, but there the onus is on you to value those assets. There's actually guides that you can see online from all those sources to give you an estimate for what those items are worth from a
Okay.
donation standpoint. So you have to say, what did you originally pay for it? How much is it worth at what they call thrift store value? So that's how they value that. So you have to go through, do a little bit of math, come up with what those numbers look like.
Cool. So those are important, and that would be part of that record keeping, right? Throughout the year, like if as you're going along, if you donate stuff and you get those, you get those tickets from Salvation Army, Goodwill, etc.
Mhm.
Um, I've kind of made it a practice to not only put, I stop in the vehicle right after I get it and I write the date and what the items are, and I've taken pictures of them before I donate
Yes.
them.
I was going to
Um,
actually just say that taking photos is 100% the best thing you
yeah.
can do to preserve that deduction if you're ever questioned on it.
And I know for me personally, when it is a truck full of stuff, it's just easy to take the picture and kind of go back later and
Mhm.
go, oh yeah, I forgot there was all this other stuff in there, right? Because you took a
Right.
couple of pictures of the
Mhm.
whole vehicle filled of junk
Right.
that you're pushing over there. So I think that's good. When people when we start talking about, okay, well, hey, what can we do to save money on taxes in general? Like we hear some themes, and I'm curious about how it really works in the real world, right? We hear about, getting married can save you money on taxes, having children, buying a house.
Mhm.
Can you give us some dollars and cents that go along with those of true or false? And if so, by how much?
True, false, and to be determined. So,
Right.
so when you go from single to married, you're doubling how much income is available at each of the lower tax brackets. So instead of having, I'm throwing out an example, $10,000 at 10% tax. If you're married, you get $20,000 at 10% tax. Not until you get to the $600,000 of taxable income space do the brackets actually start to compress, and it has less of a benefit. They don't double at that point anymore. Now, if you have two people who their earnings are comparable and they get married, their taxation picture is not going to look very different. But if their income is very different from each other, if one's $100,000, earner and the other one's a $20,000 earner, that will actually turn out to be a huge benefit between the two of them because now it's 120,000 getting double at all those lower brackets. So
Gotcha.
the depends there is the income disparity between taxpayer and spouse. Buying a home, as long as you're able to now itemize. it definitely provides a benefit. So if you bought a very inexpensive home, paid very little interest, very little, for it, didn't finance very much or had no mortgage on it, it wouldn't help you, right? But when that financed amount, that interest you pay being deductible, usually takes people from not itemizing to be able to
And
itemize.
just to be clear, Seth's talking about a benefit from your taxation point of view, right?
Right,
Not
exactly.
the ownership point of view with the
Right,
other aspects, but
right. We're just talking purely
just
taxation.
from the taxation
Yeah.
point. So lots of hats in this room, right? So
Right. And then these days, having children, a child under the age of 17 earns you a tax credit of $2,000. Once they turn 17, it's a tax credit of $500. Now, both those credits you can income out of, but it's hundreds of thousands of income to start to have those phase out.
so
Uh,
okay, so that's a term that we haven't really hit before, right? We've been talking a lot about deductions.
mhm,
Um, but this I think is probably the first time we've actually come across and used the word tax credit.
mhm.
Can you explain the differences? Because it's a
Certainly.
big deal.
Certainly. So just to be clear on the difference, a tax deduction reduces your taxable income, where a tax credit, dollar for dollar, reduces your tax bill. So if your total tax obligation for the year is $5,000 and you had a child this year, you get a $2,000 credit off that $5,000 tax bill. So now your net tax bill is $3,000. Let's switch it into homeownership terms. The solar credit. If you put a qualifying solar system on your house for solar electric, you can qualify for a tax credit of 30% of the amount. So if you spend a ton of money and spend 100 grand on a solar system, which is not impossible to do,
Right.
you could get a $30,000 federal tax credit that reduces your tax bill dollar for dollar. And of course, if your tax bill is less than that 30,000, the difference carries over to the next year. It's not a refundable credit, but you get to take it next year and use it until it's all gone.
Okay.
Yeah.
And that's an important part too, right? That's where, I think the benefit of that specific feature, and that probably exists in a lot of categories, right? As we'll talk about later, I'm sure. But credits or things that offset the actual bill that would drive the bill below zero, you may never get a check back for it, but it carries forward, right? And becomes allowable in the future.
Mhm.
And I are there time limits on those things, or it just can kind of keep kicking? You can kick the can until you have enough earnings or enough taxation to actually use it in the future.
Every type of credit is different. So some have no limit on a cap on futures, some do. Uh,
Okay.
and there are some credits that are refundable, like the child tax credit. If you have three children, all under the age of 17, and each child earns you a $2,000 credit, and then your total tax was only $5,000, but you have $6,000 in credit, you will get that $1,000 credit refunded. So credits like that are refundable. Solar credits are not. So when the Congress votes on and creates a credit, they decide, is it a refundable credit or a non-refundable credit?
Gotcha. Okay.
Yeah.
So the summation of that is getting married may or may not be a tax benefit.
Mhm.
Depends, right?
Right.
Children under 17 could result in a tax credit,
Mhm.
which is far more useful, I think, or efficient than a tax deduction, right?
Yeah, but still far less lucrative compared to what it costs you to raise that child.
Correct. Yeah. That part of the equation's not in there, right?
Yeah.
But that could be a benefit
Mhm.
in a vacuum.
Mhm.
If you don't have to spend any money for them, that'd be interesting. And of course, the house is, it depends, right?
Right.
That's
Exactly.
wonderful.
Most answers in taxation do turn out to be it depends.
It
And
depends.
the reason
Yeah.
we say that, and the kind of tongue in cheek, but it's an industry joke, is it's like, why did the chicken cross the road? Well, it depends. So because everybody's situation is different. So there's almost never a standard answer to a question. That's why we say it depends. And then we have to gather more facts and more data to apply what we're discussing to that particular taxpayer to see how it impacts them. So that's why we often give that answer, because you
Love
need
it.
information to do it. Otherwise, you might be giving, false recommendations if you don't have all the facts.
Fair. That makes total sense.
Mhm.
And with that, I think this is a perfect time to wrap this session up. Stick with us for the next one, everyone, and we will see you shortly.